Ladies and gentlemen, thank you for joining us for another episode of SPPI-TV. Oh, shucks. We're on episode 27, and I am pleased to be joined today by none other than Jason Crook of Equifax. We had the pleasure of meeting together at a conference, I think it was last summer in 2024, and where we were in Park City, Utah.
About this time.
Yeah, it was around this time last year, and we were hot off the heels of a study that SPPI was doing in the data space on the back end of alternative credit. We had conducted a study called Swipe Right. We applied for retail credit card products as a consumer, and there was a really interesting point that we ran into, a real problem. I'd been approved for one credit card, and it was from Merrick Bank, and the approval came despite there being a lock on my credit score and my credit report from all three credit bureaus. I put a lockout on Equifax, Experian, and TransUnion, and I was surprised that this bank was still able to issue a card, and that's how Jason and I met. Was we were live on stage, and I'm asking the question: does anybody actually know how this could have possibly happened? And the answer was the archived snapshot of my credit history that had been retained by Merrick in the case of a general application for whatever. It was a really interesting. Can you like bring me up to speed again? Like answer the question again. How did that happen?
Yeah, no, it's a great question. It actually is something that's very common. Most consumers or borrowers in the space, they understand enough based on what's advertised on how it should happen, and then actually the execution and how it does happen behind the scenes is where it kind of gets a little difficult. And not to spend too much time on that, because I think we spent a lot of time talking about it. But at the end of the day, we figured out that there was an archive that someone had done, or a pre-screen of your credit worthiness, so to speak, or your availability to be marketed to, let's say. And at the time that they made the offer, they had not checked, to see that you had blocked, right? That you had prevented that additional new update of any information. So had they gone in and done that, and that block was on, they wouldn't have received any new information. They would have probably been responded back to them that the block was in place, so that you had suppressed them having access to your credit file, your current credit file. So they went off and made you the offer based on old information that they had, if that makes sense.
Which should have prevented a new credit line from being initiated, or a new credit line in my name being created.
Yeah, it should have, correct. Yeah. Had they done the proper steps all the way through the process. And honestly, Patrick, this is something that you and I had lengthy discussions around. The space of credit and credit bureaus and just data in general, which I know we're going to get deep in talking about today. It's so difficult to have everybody understand the nuances. The term, I'll use the example, FICO score, right? When my credit score is the term that's frequently used in the credit space. And that can mean a lot of things, right? It doesn't just mean that there's one credit score, and that credit score is the credit score that everybody uses. And it's, that's the part that I think consumers or borrowers need to get a little bit more education on, or learn about. And I think it falls on the lender too. It falls on the lenders to be able to offer them some type of education of what they're pulling, what information they're getting about them to extend a credit offer. So there's a lot that we can unpack there and talk about that. Probably could spend a whole podcast talking about credit scores and credit in general. But that's the short of it. Is that's really what might cause your issue, and then of course what, like I said, exists in the space where consumers today.
Well, I think that most consumers don't even realize that everybody has a subprime credit score in addition to their, prime general credit scores. Everybody knows FICO. Everybody knows Vantage. don't realize that there's also subprime models too. And there's
That's
even subprime bureaus. And that's something that laymen, the general population, as they don't know exists. You know, 5 years ago, I didn't know they existed. So Jason, you've had what, more than 25 years of experience in financial services, and you now serve as senior solutions consultant at Equifax.
Yeah.
Can you share with us a little more about your career journey and what brought you into alternative finance and the data space?
Sure. It's been a long journey. I mean, I think 25 years seems like a long time, but it's probably started even before that. But for the most part, I spent most of my time in banking. I spent some time at MBNA. It's where I started in banking, and then worked for Bank of America for a short time, mainly in the retail card space. So I knew, I worked in the side of strategies and reporting and all the analytics that kind of go behind the scenes for a retail card issuer. And then I had a unique opportunity to join the non-traditional alternative credit space, which I did when I left Bank of America, and assisted a couple investors with running a portfolio of loans to consumers via the internet, right? And that's where my path out of traditional banking into alternative lending started. It was like drinking from a fire hose, because like most consumers that don't understand how credit works, and they think of, maybe the few bureaus that are out there, and they think of those scores that are out there, they don't realize the amount of data that exists. And even in the space of subprime, I mean, consumers don't realize what exists out there. And so I had to take it was a learning curve for me, but I love that information. I love that data. I love that sort of approach to getting consumers access to credit, right? I mean, we've all had that experience. You shared your experience with me on your kind of trying to get access to credit, or, for whatever purpose. And I know that there's a significant amount of consumers out there, that don't have access to credit for one reason or another. A lot of times because it's a score cut. So my journey into alternative data kind of flowed through various roles at various portfolios. I've managed 3 different portfolios in various lending models. And then I found myself wanting to take a step away from the lending and banking side and move into more kind of the vendor credit side, the data side, which is where I landed at Equifax in 2020. So that's where I'm at today. I enjoyed what I do. I enjoy helping my internal client help their external client build solutions that make sense to help their customer loan life cycle be successful and help people get access to credit. So that's where, that's a lot. And to say that, I could probably go into the weeds on a couple different things that I also kind of keep my hands and dabble in, but that's for the most part my career path that led me to Equifax.
Super. Well, I'm glad you're here, and I'm glad you're here. You mentioned something about consumers not being able to access credit for a variety of reasons, and that's a really important comment. Sure. What we noticed in the state of New Mexico, I live in New Mexico. I live near Albuquerque, and one of the surprising statistics that that had come out of our research into alternative finance and credit inclusivity and financial inclusion in New Mexico is that in the Albuquerque metropolitan area, at one point over 30% of the population of the Albuquerque metropolitan area was considered and defined by the FDIC as unbanked or underbanked. And there's no reason specifically that's applied to why they're considered unbanked or underbanked. I mean, the FDIC has criteria that qualify a consumer as unbanked or underbanked, but why are they unbanked or underbanked? And I don't think that data point is collected. And I think it's a cultural difference in New Mexico, and that consumers generally are distrustful of mainstream financial institutions. Yep. And so for a variety of reasons, which could include preclusion based on their risk profile, they're just seen as too risky by the traditional credit risk scoring, or whether it's by choice. And I think that's discounted a lot in our space. People are distrustful of mainstream finance, and they choose specifically to be unbanked or underbanked.
That's right. Yeah, that's something that I've been sort of on, I wouldn't say a mission, but it's a silent mission since I left the banking industry and moved into the alternative lending space to try to help people understand, whether it be government bodies, government regulators, or just the general population, understanding that a lot of consumers that borrow in the space of alternative lending do it not necessarily because they don't have other choices. They choose to, right? They choose to either out of convenience. A lot of times it's circumstance, right? So circumstance puts them there with, they don't have a lot of choices because they have damaged credit, or they've been past due, or they have some marks on their credit. Their traditional borrower space would look negatively at and pass on them, whether it be a particular credit score would not give them sort of the barrier to entry to get into that access to credit. So they shop in the alternative lending space. But a lot of times those have that distrust with the larger banking institutions, the ones that they don't necessarily feel like they have a fair shake at looking at the broader picture. And I'll probably talk a little bit more about that later in the podcast, related to painting that bigger picture, so that you can see it's not just about necessarily a single score, but maybe it is, but maybe we need to look at more data that feeds that score, and more information to paint a broader picture to say yes more.
And this is a perfect transition into talking about the Equifax OneScore.
Yeah.
And I that you queued that up perfectly. So Equifax launched OneScore. What was the timeline of that? How recently was that?
So there's been variations, and I'll talk a little bit about the variations in a minute, but it's been a process, and it started when Equifax realized the value in alternative data and started to acquire some of the assets that feed and are defined as alternative data. I'll mention like DataX, for example, or Teletrack. Over the course of the last 4 to 5 years, or even prior to 2020, even just before 2020, when they acquired DataX, they've acquired these assets because they realize that there's more data out there that needs to be looked at and painting that broader picture, right? And I think the important thing is to recognize that everything changes so quickly with data. There is so much data that exists, out in the world. I was reading something the other day, and I read a word that I didn't even understand. I had to look it up because it was so fascinating to me. It's zettabytes. Have you ever heard zettabytes? You ever heard that term before?
Zettabyte. Petabyte.
Yeah, terabyte, gigabyte, megabyte, but zettabytes, right? The volume of data that exists in our space out there in the ecosystem is like somewhere in the neighborhood of like 100 to 200 zettabytes. It's insane, the amount of data that exists. And they say that actually 90% of that data that's in the universe was just created in the last 2 years. So it's not that we've, there's a data that over time, as we grow, continue, that's why we have so much data, is because we've been collecting data for years, whether it be Equifax or any other institution or any other smaller, CRA or, any other particular marketing company or lead generator, whatever. But that amount of data exists mainly because we have moved so quickly with bringing things together in the cloud, right? And then the peripherals, such as our smartphones. We all have smartphones that, or most of us have smartphones that capture data and store it. And every little data point is important. I always talk about that, the story when my mother, we used to go to a local store around here called Acme. This was probably decades ago, like 20, 30 years ago. It's a grocery store. And she got the little coupon card, the clipless coupon card. And she would scan that and she would get a discount on milk and bread and things like that. That is the beginning of when data really just started to say, I need to know more about you and what you do. You bought milk on a Thursday and you bought bread, and you didn't buy bread the next time you came through. So it wasn't just about the coupon savings. It was the data that was learned about, my mother, and, me being young in my, career at MBNA Bank of America. It was fascinating to me. It was fascinating to say that this data is going to be used in a broader scale in the future. And now we're talking zettabytes of data, right? And so that is so amazing to think that amount of data, it can be so powerful to help try to solve a lot of things. And in the credit space, it's getting customers access to credit. It's getting them the ability to really us to say, I don't know you, right? So I don't know who you are. I only know you from a faceless transaction. Your application came in, or the creditor or the lender received that application, and we have that responsibility to provide information back to the creditor or the lender to make an informed decision. And that informed decision isn't designed to decline people. It's there to find a path to say, look, beyond just your credit score, what else do we know about you? What is your behavior, both in all sorts of data, right? What are you doing in that credit space within a legal framework that's governed by FCRA? Some data that's more, that's non-FCRA is more for fraud verification and things like that, or for, identity verification and fraud mitigation. But FCRA regulated data, I mean, there's a lot of it. And in the right hands and with the right tools, it can help paint a better picture, about you and the borrower to help us get them approved to say yes more. So
sure.
I've got to answer your question. I kind of went around about, but talked about data and the importance of it.
I want to touch on zettabyte, and let's put that into perspective really quick. So I'm working from my work computer, and there's like 2 terabytes of storage available on it.
Mm-hmm.
A zettabyte is 1,000 exabytes. Mm-hmm. An exabyte is 1,000 petabytes, and a petabyte is 1,000 terabytes. Mm-hmm. That is an astronomical figure. 200 zettabytes of data on just consumer behavior or data period?
In general, data in period, just data in general across the, the data infrastructure. That doesn't mean that Equifax has that amount of data. It doesn't mean that other entities have that amount of data, but just data in general that exists within the space of capturing data at various cloud servers or repositories, repos. And the crazy thing is a lot of data that's captured is live, right? And I know we'll talk a little bit about AI and the data that's created from AI, but the data that's repos data is zettabytes, right? The data that still can be fed into that can exponentially grow that even further is live data, right? We have products at Equifax that partially has a basis in repos data, but also learns as the applicant comes in, right? And it goes out and gets that information, your partners and vendors that we work with to bring that and enhance the data. So it's always learning every minute. And that's, again, this probably stems into more the AI side of the discussion, but that's the nature of the world we live in today. It's just it's an amazing thing. It's a little scary, but it's amazing. Yeah,
it's a lot of data. So we touched on how OneScore blends traditional credit data with alternative sources, which those alternative data sources include telecom, utilities, non-traditional lending histories. We're even seeing buy now, pay later buy now, pay later payment history inclusion on credit reporting. I've seen some recent headlines about how the CFPB was making turns to incorporate buy now, pay later payment history, or at least make preliminary rulemaking to allow inclusion of buy now, pay later payment history. Because right now, my understanding is that buy now, pay later payment history and alternative loan products generally, actually, their inclusion on your credit report hurts you no matter what, because the alternative loan itself, that product is seen as inherently risky. So whether or not you have good payment history, a payday loan, a short-term loan, whatever it is, if that were included on a mainstream score like FICO or Vantage, it hurts your credit. It doesn't help it. And that's what OneScore hopes to solve.
Yes. So there's a lot to unpack there. And I definitely want to kind of get into the nuances of OneScore and what it does solve. But let me go back to really what the core issue is, at least from your perspective, and maybe clarify a few things. You're not wrong, but there are definitely elements that are spot on as it relates to the challenge that we as a credit bureau, traditional credit bureau, are up against, and any credit bureau really, any place that house traditional data, right? So the variables that you're talking about, and let me clarify something as well. Buy now, pay later, and this is something that I think most need to understand. It's no different than any other product that would have existed, in the course of product history, right? When I'm sure when a particular type of mortgage product was created, whether it be an ARM or whether it be some other type of product, people are scratching their head and going, what kind of product is this? This is not a traditional fixed payment. I don't understand, right? It's just another, I wouldn't say manipulation, but it's just another different structure of terms. So when we talk about BNPL or buy and pay later, it's not like that it's a foreign product that's brand new. It's just that the terms are structured differently, right? And with those terms being structured, when you try to fit a square peg into a round hole, it's not always easy, right? It doesn't mean that you can't. You just have to widen the hole, or you have to figure out a different way to fit it in there, right? And with Equifax, we've actually partnered recently to try to tackle this challenge. The group that we partner with, I think Clarify, I think is the name of it. I apologize, I always mess up the name, but it's like Clarify or something along those lines. And I'm gonna probably glance over to see if I can remember what the name of it was. Clarify. I guess that's the name. I don't know why I can't remember that name, but I just want I want to make sure I was correct on it. We partnered recently with Clarify to help bring some insights as it relates to what happens in the BNPL space, right? So they're one of the larger or largest, I don't know if they're the larger platforms that provide solutions for short-term loan types. So not always necessarily the payday lenders or necessarily the cash lenders that maybe store brick and mortar storefront lenders, because there are a lot of solutions that are out there for those. But they focus more on the I would call the short-term, kind of borrowing in the BNPL space. But they're very large, and they have a lot of partners and lenders that work through their platform. So we partnered with Clarify in order to do better understand how these loans are being used, right? The performance on these loans, and better understand how we can provide reporting that doesn't impact the consumer. Because to your exact point, you got a round hole, square peg, right? How do you fit that in there? How do you fit that particular product in there? And the way that most traditional bureaus are structured is under Metro data, Metro 2, Metro 5 data. And that formatting or that reporting process, it doesn't always fit properly with certain lending products that come out of certain platforms. So you have to kind of work around that.
Sorry, just to clarify, Metro is just a framework or a template for how data is stored. And
it's a template of how it's reported or contributed. So we have something called data contributing, which allows a lender to contribute the data from the beginning of the life cycle to the end of the life cycle. Essentially, when a customer comes in with an application and what happened to that, if they get a loan, what happened with that, as well as the performance long term, whether they paid back or they did not. That information is all formatted into that Metro data, and that's sent to a traditional bureau. Most bureaus have that format of reporting and most lenders can prescribe to that. Most traditional banks and financial institutions subscribe to that. That being said, in the alternative space, that's what really kind of instigated the growth of some of these alternative bureaus like DataX, Teletrack, and the others that may exist out there prior to them being acquired by Equifax, is that non-traditional reporting, right, on non-traditional loans, right? So that made it easier where they didn't necessarily report using the Metro format. But to your point you made earlier, if you take that square peg and you put it in the round hole, even if you get the formatting right, the data that you're putting in there could potentially impact a myriad of things. It could be the potential credit scores that could potentially be negatively impacted because of the terms of the agreement, right? Because it doesn't look like a traditional fixed loan or a traditional loan that fits in the mold. And so the concern across the board at all bureaus, including Equifax, was we need to make sure that we don't harm the customer by allowing these types of trades that look like they look in the BNPL space into something that doesn't react well to that. And we've actually done a lot of work with FICO and Vantage, particularly to help understand the impacts of that, right? To putting something in the square peg in the round hole and what it would look like to the consumer. And so at this point in time, that's why we partnered with Clarify. We need to better understand the product and how the product operates, what the customer behavior is, to be able to see what's the right thing to do to make sure we can push this into a traditional credit report, data framework, and allow that to be still not negatively impacted just by its presence of being there, which it shouldn't. Right now, if they do have poor performance, they don't repay, they're delinquent,
Sure,
then
that's different.
yeah,
I'm just
I
talking
would
about
make
the
a move.
presence
Yeah,
of it on a
with the
credit
presence.
report. Yeah,
That's right.
yeah,
So that's a whole other discussion, and it's a very hot topic. I talk to a lot of clients today. Their number one focus, or one of the number one top focuses, is BNPL and what's happening with BNPL. I think it's 50% of borrowers today, or consumers today, use a BNPL product. That's half the population are using these types of products. And I'll tell you,
I've used it.
yeah, I have as well. I have as well. And you know why I use it, Patrick? Convenience. I don't
Yeah,
need to go through getting a credit line increase if I need more money at a bank for a credit card that I may have, right? If I need a little bit more, I know that I can actually structure my repayment specifically the way I want to structure it. So if I want 2 payments or 1 payment or 10 payments, they give me options. And they're usually at the point of sale, so they're convenient, right? So you're online, you're buying a particular item, and you can pick to choose one of these BNPLs. So BNPL is here to stay. My bottom line is we just need to, as an industry and as a bureau, need to make sure we do right by customers and ensuring that we put it in the right framework, bring it in, and that it doesn't impact customer in a negative manner. And that's what I'll tell you. A lot of resources are being put to that, and that recent partnership with Clarify is a big piece of that.
So we talked about, actually, I think I have this on next on my list of questions for you. We almost covered this already, but let's just get these facts and figures out. So OneScore says, or there's a claim that from the OneScore brochure or pamphlet that claims that it makes applicants 21% more scoreable and boosts approval rates by up to 15.5%. And that's phenomenal.
Yes.
And we already answered the question, how does alternative data make this possible?
Yeah.
So let's go back to the conversation that we were having about artificial intelligence. And machine learning obviously plays a huge role in OneScore. Sure. And I saw mention of advanced tools like gradient boosting. Can we talk about how those techniques are actually improving the way lenders assess risk?
Yeah, no, it's a great question, because let me go back. The core foundation is in the data, right? And we've already talked about the fact that we have alternative data. We have access to that view of the non-traditionals, the telephony type data, which we talked about. How is someone paying on their their cell phone, that performance, because people behave differently with different types of products. For example, the biggest example is I want to keep my cell phone. I don't want them to have an issue where I turn my cell phone off. I need that, right? Or I don't want them to come repo my car, so I'm going to pay my car loan. But an unsecured product like a personal loan or a credit card, what do they have? My signature on file. So the mindset of a consumer behavior is different than when they have something that's kind of attached to it. So that alternative data in the telephony data, the DataX and Teletrack, which is where they perform in that sort of unsecured cash lending space, is very, very unique, in addition to the core credit. So the core credit, I think, and the last I checked, and I may need to go back and verify my numbers, but there's probably 7,000 attributes in Equifax. We have 7,000 attributes. What is an attribute? An attribute, it says, what is this plus this? How many, it's like a frequency of something. It says, how many days have you been past due in the last 30 days? How many times have you been past due in the last 30 days? How many times have you missed a payment, right? It's a unit of measure of, and those attributes, there's many of them. There's 7,000 some odd attributes. And of those attributes, there's about, I don't want to say 1,600 alternative data attributes that source from alternative data, right? So here we're going to go back to that initial conversation when we talked about zettabytes, right, where there's a lot of data, right? So we got 7,000 attributes that are built from all this data. How do you make sense of it, right? How does any one individual, I mean, I could be, a PhD and a data analyst, data scientist, and be so uber smart. I just don't have the bandwidth to get through the what ifs, right? So I have to think of a way that, how do I optimize the what ifs scenarios? How do I run that faster? That, I can tell, AI to do this particular transaction, or I can tell, my data scientists that maybe work for me to do all these transactions. But if I have something like AI, which we're all learning is becoming a very integral part of our lives, which Equifax does, we have something called Amplify AI and Neuro Decision. And those two technologies that are unique to Equifax, again, its framework is an AI framework. It is able to take all those data points and make sense of them, right? And see where there's heat, The old process of being a strategist when I was working back at the bank, and shoot, even when I was in lending, we would look at heat maps and we would determine where we saw heat and what things stood out. And then we would focus on that area and say, well, why is that showing heat? Why is that showing something? And what I mean by heat is, you know, any type of an indicator of a difference, right? Beyond the norm. Is it risk, right? Or is it, you know, not risk? You know, those two elements, the heat could show that. You know, where could we have the ability to take that? And AI, Amplify AI, NeuroDecision at Equifax does that at a, you know, amazing speeds. And that's where we're able to be able to take that data, you know, the 7,000 attributes or the 1,600 or plus attributes that are unique in alternative data, and get to lenders a better picture, paint a better picture of who Patrick is, right? What is Patrick's credit history? Well, he's had a car loan, he's had a mortgage, what have you. But did you know Patrick had borrowed 3 times from a payday lender, for example, and he paid them back successfully? So Patrick may have chosen to do that, right? That's a great thing. That's great credit history that you need to see. But what if he's past due on some of his traditional trade lines, and he's also charged off or not paid these alternative lending, or he's not paying his cell phone? Any of that information that you don't see, I look at it as saying it's taking traditional credit and taking alternative data and getting what's invisible to the lender. Those invisible attributes, the invisible information that they don't see about Patrick. How can we take that and then use it in a manner in which it makes sense? And that's where OneScore comes in. OneScore allows a lender to say, I need to understand a certain risk point. And it's different for every lender. I know one of the things you're going to be like scratching your head at when I say this, which is we have, and you're like, wait a minute, I thought it was just one score. Why do you need more than one OneScore?
Well, there's more than one FICO score.
That's correct. There's different versions of FICO. There's different versions. Now, the difference in why you have more, what I would call flavor of OneScore, is because there's different outcomes that need to occur. A great example in the subprime space, the focus is first payment default. First payment default is how a lot of lenders measure success. Did my customer, when I offer this loan to them on their first payment, did they miss it or not? And if they miss it, there's a higher propensity that they will go bad and charge off, right? The same unit of measure in the traditional borrower side or your traditional lending side is delinquency. Typically, when you get to like a 60 or 90-day delinquency, that's a unit of measure that's important for those lenders to understand at the point in time when this customer becomes a risk to us, where we have to take it as a loss, and or we have to determine what our strategy is when a consumer goes down that path. So what does OneScore do? It takes either core credit and all this alternative data, and it makes sense of it to say, what's the propensity that a customer, this applicant will go past due? Meaning, will they miss a payment on that first payment? And that's a unique flavor of OneScore that allows us to see that. Or what's the 90 days delinquent? And there's a unique flavor of OneScore that shows that. The beauty of it is it's not a knockout. It's not trying to prevent a customer from getting access to credit, but it's expanding the view, the picture of what a lender needs to see to help get Patrick that loan. Because maybe Patrick missed a payment or two in his traditional, auto loan. And if I just looked at that and your credit score that we always use, whatever they may be, the advantage of the FICOs, right? Maybe there's a threshold that they will not go below. We call that a cut point. And a lot of decision at lenders, they use a particular threshold, and they might have some wiggle room above and below it. But what if you could see below it that they hit that cut point, but then when you pulled in alternative data or you pulled in OneScore, that they actually performed very well in the alternative data space. They paid everything on time. They have good access to credit. They're not loan stacking, things like that. And you can see that. You say, well, I'm willing to take a risk on that. Maybe the price is a little bit more for it, but I'm willing to take a risk on it because what I'm seeing here is that they are a good payer outside of the traditional credit space. Does that make sense?
It does. It does very much so. It's fascinating. I still can't. I can't wrap my mind around just how deep this space is.
Yeah. It's zettabyte again. We're back to zettabyte, right? The zettabyte, it blew my mind when I was like, I understand millions, billions, and trillions, but when we talk data, zettabyte was fascinating.
So I want to shift back to a general discussion about alternative finance. You've got so much experience in this space, not just on the data side, but just alternative finance generally. Based on your experience, what's the biggest misconception about alternative finance that you've seen from within your industry, from the general public, and then in your interactions with policymakers and lawmakers around the country?
Yeah, that's a very, I wouldn't say loaded question, but it's an intentional question, because I can say that is probably the hardest thing, being a lender in the subprime alternative lending space, and then also now being on the other side of the table in the data side, and trying to articulate to both my peers inside of the walls of Equifax and really in the industry outside, or when I'm going and interacting with various government regulators through various programs and such, trying to have them understand that the alternative data lending space, even the payday lenders, even the high interest lenders that people perceive to be bad. We hear the term loan shark, we hear the
predatory,
term predatory and things like that. And I have to be cautious when I say this, but it's the truth, which is, we need to realize that in a space where consumers have very limited access, either by choice or circumstance, mainly by circumstance, right? These lenders are taking and offering access to credit that's extremely risky, extremely risky.
Well, and that's reflected in the price. I mean, high risk credit where there's a great propensity for charge off.
That's right.
Yeah.
Which is another discussion that I think we could go down a rabbit hole, and I won't necessarily go too deep, but when you
how many more episodes of this do we have to do to get through everything?
Right. And when you talk about price, though, and you look at a cup of coffee, right, and you look at how much that cup of coffee costs, and then you look at how much a particular brand that we won't mention charges for that cup of coffee, right, and you look at the markup, the retail markup on a cup of coffee. There's nobody jumping up and down and screaming and crying because it costs a nickel and there's a 500,000% markup on that cup of coffee. They'll get their cup of coffee. Why? Because they chose that they want that cup of coffee. Could they get a cheaper option? Sure, they could go somewhere else and get a cheaper option. But the customer chose to buy that cup of coffee. And I liken that to the lending space. The lending space has offerings. Are there bad coffee vendors and good coffee vendors? Sure. Right. But at the end of the day, there's a lot of good coffee lenders, or a lot of lenders, right? Like I say coffee lenders together, a lot of coffee dealers, but a lot of lenders like coffee dealers, right, that are very good product offerings. It just allows the consumer to make a choice on whether they are concerned about what optically may not be applicable in the space of lending. You look at the TILA, which is what we're required, our lenders are required to articulate the cost of credit.
Oh, right? The Truth in Lending Act. I love making fun of the Truth in Lending Act.
And that's a wonderful unit of measure when it's applicable. When the loan goes beyond 12 months, it's absolutely applicable, because that brings it back to a unit of measure. It rewinds it back to a single point in time, 12 months, to say this is after annually, this is what will cost you for credit. But when you look at someone who offers like a BNPL product, or that offers a product that's only like 2 payments or 1 payment or 6 months, it's below the threshold of that 12 and that annual. And therefore, it's the calculation that you have to disclose to be in line with everyone else in the lending space to show what your cost of credit is a little bit distorted. And so that's the message that I would say. I don't necessarily want to hang my hat on, and again, I'm taking my Equifax hat off here, right? Sure. This is my experience within the lending industry, and say we just need to have better dialogue and better education about economics of loans and lending and risk. And as a culture, as a country and as a culture, have a better understanding as to why things are where they are. If you're willing to go spend, X amount of dollars on a cup of coffee that probably cost, a penny to make or a nickel to make, and you're making that choice, then we should allow our customers to have the same choice for credit, right? And go out and acquire the types of credit that they want at whatever price they see. That's kind of
my take is that I'm so glad you brought up APR. I detest APR as a measure of a cost of any loan product. APR is such a broken metric.
Yeah, it's an old metric. It has its place. Don't get me wrong. It has its place.
I don't know if it has its place anymore.
But I think it's not at all. Yeah, it has its place when you're looking at a loan that's over 12 months. At the end of the day, it has its place.
See, I think it has a place in like the revolving credit space.
Sure.
I think it only has a place in the revolving credit space. If it's a fixed rate loan product, I don't think that APR should generally be applicable. And the reason I bring that up is I'm gonna put something out there right now, and it is I'm so excited. I've been in the policy space for about 3 years, and I've been at the policy space at the Southwest Public Policy Institute for about 3 years. Before that, I was at another think tank for 3 years before that, and my entire 6-year professional experience in this space, I have always wanted to get published by the Wall Street Journal, and I got accepted for publication at the Wall Street Journal by their opinion editor, James Taranto. And it was a piece that was very critical of APR, but APR specifically in the context of what I am claiming is the most egregiously predatory loan product in the history of mankind, which is the modern American mortgage. I think that a mortgage is the.
But I hear you. It comes down to this. It comes down to the what is the rate, right? So not APR. What is the rate?
It's 5% APR.
Well, yeah, but no, I'm saying in general, like just the metrics that we use this for measurement. We have the loan amount, the term, and the rate you're willing to charge. Any one of those three can be manipulated to tell a picture to make it look like it's a favorable product to anybody, regardless of what it is. There's measures of secured versus unsecured that also kind of factor into that as well. But at the end of the day, that's the piece that I think is the misunderstanding. And when you look at something like a traditional mortgage at a 5% rate, over time, it can be an extremely expensive product over time, but there's a secured asset associated with that. And, so
why is there such a high price associated with a mortgage product when the risk is relatively low because it's collateralized?
But I don't understand of that, Patrick, is that it's less than 5%. So really, what is the right number, right? I think there's an initiative, and again, we're going down a rabbit hole on this rate thing, but at the end of the day, there's an initiative that says that 36% is the magic number. Why is 36% the magic number?
Isn't that based on a 100-year-old metric? Like, wasn't that originally decided back in the early 1900s? Some economists suggested it because it was at that time their break-even point of a lender. 36% APR was like the break-even point. And that's a 100-year-old metric. It's over 100 years old at this point, but it's what everybody defaults back to. It's what's codified in the Military Lending Act. It's what's being advocated for by national politicians like Dick Durbin and Liz Warren. Is they're advocating for this 36% interest rate cap on short-term loan products. And then on the other side, they're advocating for a 10% rate cap on credit cards. I don't understand where they're getting these numbers from.
Well, it's arbitrary in some cases. Again, it's an older metric, but keep in mind that the Military Lending Act, or the Soldiers and Sailors Act that associates with that, actually says when you're on active duty, they can't charge more than 6%. So why 6%? What happened to 36%? Right? You figure in your mind, you're saying, so it seems like these are very arbitrary. And again, I like to look at it as we have a duty as of course, myself being a data provider, right, as well as someone who's in the public, space like yourself within, public policy, as well as myself being a lender provider. We have a duty to educate the policymakers, educate them on what it is and what it isn't, right? Because I think a lot of times things are done in the spirit of protecting consumers, right? In the spirit of, but what they don't realize that when decisions are made, it actually negatively impacts consumers. I know that you and I have had conversations about lead gen, right? I know you want to talk a little bit about lead gen today. And that's a great example of that as well, where we're reacting to the moment. We're reacting to what we see, and we think we're going to go out and protect a consumer. But what you don't realize is you're actually hurting consumers by certain policies that are put in place because the education's not there. Again, I don't blame the policymakers in the sense that I blame them from a whatever political perspective or political persuasion. I blame them because I don't think that they're fully understand and educated on the nuances.
Well, and that's a great point. These policymakers that are regulating the industry that we're all participating in don't have an understanding of these products, and they don't have an understanding of these products because they've never had to touch these products. I mean, has Liz Warren ever been charged an overdraft fee? When's the last time Liz Warren paid for a payday loan or a short-term small dollar loan product? I doubt that these people are in an income bracket that far exceeds the average American. They're not going to need these loan products. They're just in a different bracket. I mean, the only reason I applied for the short-term small dollar loan products that we tested in our study at SPPI, No Loan for You and No Loan for You Too, is we wanted to test the space in the aftermath of a rate cap at a state level. That is the only reason I touched a short-term small dollar loan product at all. Whereas, I mean, but I now have the experience. I've actually applied for a short-term small dollar loan product from banks and credit unions, and I know that banks and credit unions have their space in the market, but in the short-term emergency liquidity space, they generally appeared unprepared to lend money in this space. I mean, sure, props to Wells Fargo for generating their Wells Fargo Flex loan, but it just failed to deliver specifically when under the conditions that I was testing it.
Yeah, I have an opinion on why that is, but I have an opinion on why that is, and I think a lot of it has to do with what we're trying to solve at Equifax today, which is the access to the data. The more data, the more view they have, and the more insights they have to make better decisions can help everyone win, right? It provides opportunity for everyone to say, you know, I'm informed now. I'm informed on, you know, not just on the policy of the cost of credit and the elements we talked about, but I'm informed on Patrick and the behavior he has across the whole spectrum of credit, and allows me to kind of say, I'm going to say yes to Patrick, right? I may never have said yes to him before, or if Patrick is maybe, like you said, are not in need of these types of products, but there's millions of other consumers out there that are getting declined because they don't have the you know, the groups like Wells Fargo, groups like other banks that may exist, don't have all the insights they need to make an informed decision. They're more hesitant to make that because the risk is too high, because they don't have the insights. And that's really where, you know, what I've really enjoyed about being at Equifax for the last 5 years is that when I got on the other side of the table, I was a lender, you know, subprime lender. I was an alternative data lender. I was in that space. I was in the banking space for retail card. When I got to sit on the other side of the table and realize how much data exists that's very valuable, and be able to provide that to, you know, our clients, it opened my eyes up to say, look, this is how we're going to win. This is how the industry is going to win, by being a little bit more accepting to not what we've always done and what we've always known, whether it be a scorecard on a credit score, or whether it be just traditional basic credit that we've looked at or provided to various lenders, but how do we give them more view, more to paint that bigger picture and help those customers who are right on the cusp, that have a willingness to repay, but we can prove that they have an ability and stability to repay. And that's the harder thing in the metric of lending, which is ability and stability can be easily defined in attributes and metrics. We can tell that tomorrow. What's their ability? Yep, they have income. What's their stability? Well, they show payment performance, right? Willingness to repay. How do you even begin to start to capture that? Well, that's where the behavioral elements of credit borrowing come into play, and alternative data really shines. It doesn't solve willingness, because that's still a decision by the person who has to repay, but it gives you a framework to say, I have this much more information to show that they have a willingness to repay.
Sure.
Does that make sense? Yeah.
It does. It does. It most definitely does. Ladies and gentlemen, you're listening to episode 27 of SPPI-TV. I'm speaking with our guest today, Jason Crook, with Equifax, and we're discussing data-driven financial inclusivity. We've had a great conversation over the last 45 minutes or so. I've learned a lot myself. Again, Jason is a wealth of knowledge. I can't thank him enough for being here. We're going to have a future episode of this to dive into everything else that came up during this one. But I really wanted to take one final look and close out the episode. What excites you most about the next chapter for alternative finance? And do you intend on staying involved?
Yes. So short answer is yes. As you know, Patrick, we
keep getting pulled in. I think you've mentioned that before. We
have a personal friendship. So, I have other, we'll call them hobbies,
sure.
Right? Which, I have a passion for beekeeping. And I think over the last, probably 10 years, I've grown that passion significantly. It's not something that I would look to do as a full-time, because I know they always say that when you do something full-time as a hobby, you tend to hate the hobby. because it becomes a job. I actually do enjoy, and one of the crazier things is that I've been in this space for so long. It's hard to pull me away. Even when I went to Equifax on the other side of the table, I had to get myself back involved in alternative data in some way. I couldn't just walk away from it because I'm so passionate about what it does for people, right? It allows people to live their financial best. It allows people to have access to credit that they would never have before. It allows them to solve problems. I'm a fixer by nature. My dad, if something's broken, we go down the barn and I fix it, right? Or I figure out a way to fix it. And in the space where someone's credit is either damaged or they have a thin file, being able to provide the things like OneScore and alternative data, and this is a way of fixing. It's a way of fixing people's problems when their car breaks down, they don't have any money to fix it, or they lost their job and they need to go from paycheck to paycheck or try to figure out what's going to fill that gap. There's people out there that are providing those solutions, and I want to help them say yes more to more consumers and have confidence that they're doing it securely and they're doing it with lower risk, but also understand that that they're helping those situations better, fixing things, right? I've learned so much in the last 25 plus years from alternative data. I've learned even more in the last 10 years from being a beekeeper. And I will leave you with this thought as it relates to beekeeping, because I love to talk about it when I get a chance. My peers and my family know this. I always like to kind of bring it back to beekeeping, because it does, if you think about the ecosystem or the superorganism that exists within a beehive and how it operates, from a day a bee is born to the day it dies, it has a job. It doesn't ask for another bee's job. It doesn't say, I need a day off or a vacation. It does its specific job. It may not be the greatest job to do. It may not be the best job, but it does the specific job that it does, and it's at that point in time. And a bee only lives typically about 45 to 50 days. So in that short lifespan of 45 to 50 days, it does its job. Why does it do its job? Well, it does its job for the greater good of the future colony, not for its own selfish pursuits. So I look at that and I take that piece and I say, in specialty financial alternative data, in this lending industry that I've been part of for 30 years, this is my job. I have to be able to help people figure out how to have access to credit. How do I help future generations understand and learn and grow and become a better, steward of what we have and what we do, so that the future generations have the same things that I've had when I was here. And so that's how I apply my craft of beekeeping to alternative finance. And I think it's a very valuable lesson learned even in our own society outside of alternative finance, that if we worked as a society better for the greater good of the future, we would be better off as a society. So,
Jason, that was a beautiful way to end out today's episode. Thank you so much. And I couldn't agree with you more. And that's why we're here at the Southwest Public Policy Institute, to try to push these politicians into adopting better policies that can facilitate greater credit inclusivity and financial inclusivity for not just our generation today, but future generations, and preserving that backbone of the American economy. Jason, thank you so much. We'll see you next time. And ladies and gentlemen, thank you for tuning in for another episode of SPPI-TV. I'm your host, Patrick Brenner, president of the Southwest Public Policy Institute, and I will see you next time.